The Bank of Uganda has managed to control the inflationary trends despite the moderate rise in both headline and core inflation in December last year, maintaining the lending rate at 12%. However, the annual headline rose to 5.5% as well as core inflation to 4.6% in December 2012, which is largely attributed to seasonal factors and demand pressures associated with the festive season.
Bank of Uganda will maintain the central bank rate at 12%. The band on the CBR will be maintained at plus minus 3 percentage points on the CBR, and the margin on the discount rate at 4 percentage points on the CBR.
The real economic indicators show that economic activity has started to pick up, with quarterly gross domestic product expanding by 2% in the first quarter of 2012-2013 financial year. This is expected to be reflected by commercial banks if they lower lending rates, as early projections this year indicate strong economic growth.
Growth in monetary aggregates is also picking up, although private sector credit growth remains subdued, partly on account of high lending rates on shilling-denominated loans. Given the lag in the monetary policy transmission mechanism, I expect a further reduction in lending rates.
Economic growth can be in the range of 5, which is still strong, or because of that such a kind of impact, say from the external sources, etc. But we still believe that now that is reflective of stronger economic growth than we had anticipated.
Though the central bank has figures that give a personal outlook for the country's economy, foreign currency denominated lending remains dominant and growth in shilling lending is still subdued. Depreciation pressures on the exchange rate continues due to increased currency demand and heavy government injections, thus making the public to have minimal feeling of lower lending rate. Bwire, WBS Business.